As the market digests interest rates being higher for longer, David, what does a pause mean for investors?
Yeah, that's a good question, Nisha. We're in this situation at the moment with second order price inflation effects, especially associated with the rising energy and the strong labour market. And that could well keep central banks on pause, could well keep interest rates or base rates, Fed fund rates around current levels for most of the next year. And I don't really think that's something many investors expected, even as recently as a month or so ago. If we look at the history of the past couple of decades, really up until 2020, most investors became used to thinking of bonds as a capital gain asset class. And I think investors became overly excited, and we invented new economic theory to explain it all, to justify huge central bank balance sheets and negative interest rate policy. I'm on record as saying not only was that kind of madness, but without even the need for hindsight, it didn't feel enough. I don't think it's necessary. And it has taken a couple of years for markets to normalise, for interest rates to move, I would say, closer to the normal level. Some are talking about these as extreme highs, but if you take a sort of slightly longer term view and think about the past 30 or 40 years rather than just the past 10, then as I say, really interest rates are just about at normal, not at extreme. So there's quite a good chance based on that alone that we don't need to see the aggressive cuts next year in policy rates that many were talking about. And I think really that's what the Federal Reserve has finally admitted with its change to the dot plot forecasts a week or so ago. Undoubtedly, the economies are slowing, but perhaps the market is starting to wake up to that too, that just because the economy is slowing doesn't mean that we need aggressive rate cuts. And certainly rising US commodity prices and the chance of a US government shutdown are also spooking investors in all asset classes at the moment. That said, if we look at a core portfolio of simply of investment grade bonds, so sovereigns and credit, investment grade credit, we can construct a portfolio quite easily that pays investors around 6% per annum in sterling or US dollar terms. Don't really need to be chasing capital gain just to make that core bond asset class look attractive, Nisha.
David, do you think then that alters the risk profile investors need to become interested in bonds again?
Absolutely, and I think that's a very well made point. Again, a couple of years ago, the chances to make this type of return from bond markets forced investors into higher risk, illiquid, poorly rated securities. To find 5 or 6%, you really were fishing around in parts of the market that I'm never really much interested in. And today, those same returns, so again, 5, 6% or so, are widely available on the highest quality, statistically least risky, and almost certainly the most liquid parts of the bond market. Okay, so consistent mid-single digit returns might not excite everyone, but as we said before, for those looking for a sensible place, a long-term home for value assets, then these likely inflation-beating returns could, I think, be a really interesting starting point, Nisha.
So, I mean, that sounds like a bit of a tailwind for the asset class. And would you go on further to say it might attract a wider pool of investors, therefore?
Well, I think that's possible. With the yield on core bonds now well above that typically available on value equity, we could certainly see more money switching, especially to meet the needs of those longer term value investors, not least of all if we are going through likely to enter a period of lower economic growth. And of course, there's still a huge amount of money in cash deposit and money market funds, more so in the US perhaps than in the European continental Europe. That's understandable, but undoubtedly in time we will see rates paid in those products decline to some extent as interest rates drift lower. The word fall, that suggests something dramatic, but certainly central banks trim interest rates probably over the next 12 to 18 months. So investors in those asset classes, particularly in those in cash product, will need to work out when they should be moving to longer term products and locking in the higher yield levels currently available for a multi-period, rather than worrying about every day whether or not central banks will cut and as a result reduce the level of income they take from money. So yeah, I think a good possibility that we could see some asset class switching. which as a bond investor, that would be very nice to see.
Thanks, David. It's great to hear you share your thoughts on why core bonds can represent a high quality investment solution in this higher for longer environment. Well, we hope you enjoyed today's episode. Have a great rest of the day.